The unfolding economic landscape. Analyzing the US-China trade war and its global repercussions. Are we on the brink of a new world order shaped by trade conflicts? The US-China trade war, far from being a localized dispute, has sent shockwaves across the global economy, impacting trade flows, investment strategies, and geopolitical alliances. The US-China trade war, initiated with the imposition of tariffs on goods traded between the two nations, represents a complex interplay of economic, political, and strategic factors. The initial premise centered on addressing trade imbalances, protecting intellectual property, and leveling the playing field for American businesses. However, the conflict has since escalated, marked by retaliatory tariffs and broader concerns about technological dominance and geopolitical influence. The sweeping U.S. tariff increases in 2025, impacting numerous trade partners, signify a critical juncture in this ongoing saga. The tit-for-tat escalation has resulted in a bilateral tariff rate of approximately 125%, creating a significant barrier to trade between the two economic powerhouses. This has not only affected the US and China, but has also had far-reaching consequences for global supply chains and international trade relations. The imposition of reciprocal tariffs by the US in April 2025 further complicates the landscape, raising questions about the future of multilateral trade agreements and the potential for increased protectionism. One of the most immediate consequences of the trade war has been the diversion of trade flows. As tariffs make goods from the US and China more expensive, businesses are seeking alternative sources and markets. This has led to a reshaping of global trade patterns, with countries like the Euro area, UK, Latin America, Canada, and Mexico emerging as key destinations for redirected Chinese exports. This diversion presents both opportunities and challenges. While some countries benefit from increased exports and investment, others face increased competition and potential disruptions to their existing trade relationships. The long-term implications of these shifts remain uncertain, but it is clear that the trade war is accelerating the fragmentation of the global trading system. The trade war has had a particularly pronounced impact on specific commodity markets, most notably oilseeds. The U.S. government's tariff measures targeting China have effectively wiped out U.S. oilseed exports to China, leading to a significant erosion of U.S. global oilseed trade. This has had a ripple effect on farmers, agricultural businesses, and related industries. The disruption in oilseed trade highlights the vulnerability of commodity markets to geopolitical tensions. It also underscores the importance of diversification and risk management for businesses operating in these sectors. As the trade war continues, other commodity markets may face similar pressures, requiring careful monitoring and strategic adaptation. While the US and China have both experienced economic losses as a result of the trade war, some countries have emerged as relative winners. Countries like India, Mexico, and Vietnam have witnessed increased foreign direct investment and expanded manufacturing capacity as businesses seek to relocate production and diversify their supply chains. However, it is important to note that these gains may be unevenly distributed and may not fully offset the overall negative impact of the trade war on the global economy. Furthermore, the long-term sustainability of these gains depends on a variety of factors, including policy stability, infrastructure development, and workforce skills. The trade war has severely disrupted global supply chains, forcing companies to reevaluate their sourcing strategies and production locations. Businesses reliant on Chinese manufacturing or American consumers face higher production costs, declining profitability, and increased uncertainty. This has led to a wave of reshoring, nearshoring, and diversification efforts. The disruptions to supply chains highlight the interconnectedness of the global economy and the vulnerability of businesses to geopolitical risks. Companies are now prioritizing resilience, flexibility, and transparency in their supply chain management practices. This may involve investing in new technologies, developing alternative sourcing options, and strengthening relationships with suppliers. The escalating trade war has increased the risk of recession for both the U.S. economy and the global economy. A collapse in imports caused by tariffs could lead to a dramatic increase in the prices of manufactured goods, or make certain imported products completely unprofitable, causing them to disappear from the U.S. market. This could trigger a slowdown in economic activity, job losses, and financial instability. The IMF estimated that the trade war reduced global economic growth by 0.8% in 2019, and the impact is likely to be even greater in subsequent years. Policymakers need to carefully consider the potential consequences of further trade restrictions and explore alternative strategies for resolving trade disputes. The tariffs imposed in the trade war have a significant impact on prices, limiting consumer access to goods and increasing the general price level. This disproportionately affects low-income households, who spend a larger share of their income on essential goods. The increased cost of imported goods can also reduce consumer demand and slow down economic growth. The impact on prices underscores the importance of considering the distributional effects of trade policies. Policymakers need to implement measures to mitigate the negative impact on consumers, such as targeted subsidies or tax relief. The trade war has created a climate of uncertainty in global markets, with businesses left scrambling to assess the implications of higher costs and disrupted supply chains. This uncertainty can discourage investment, reduce hiring, and slow down economic growth. The lack of clarity about the future of trade relations makes it difficult for businesses to plan for the long term. To mitigate the negative impact of uncertainty, policymakers need to provide clear and consistent guidance on trade policy. They also need to work with businesses to help them adapt to the changing global landscape. This may involve providing access to financing, training, and technical assistance. The US-China trade war is not just an economic dispute, it is also a strategic competition for global leadership. The conflict has implications for technology, security, and international relations. As the two countries vie for influence, the global order is likely to become more fragmented and multipolar. Looking ahead, the future of the trade war remains uncertain. While there may be opportunities for negotiation and compromise, the underlying tensions between the US and China are likely to persist. Businesses and investors need to prepare for a world of increased geopolitical risk and uncertainty. The US-China trade war presents significant challenges and opportunities for investors, economists, businesses, students, and policymakers alike. To navigate this new economic reality, we urge you to stay informed. Continuously monitor developments in trade policy and their potential impact on your investments, businesses, or research. Diversify. Reduce your exposure to specific markets or industries that are particularly vulnerable to trade tensions. Engage. Participate in policy debates and advocate for trade policies that promote economic growth and stability. Innovate. Develop new products, services, and business models that can thrive in a changing global landscape. Collaborate. Work with other stakeholders to find solutions to the challenges posed by the trade war. By taking these steps, we can collectively mitigate the negative impacts of the trade war and build a more resilient and prosperous global economy. If you found this video helpful, please give it a like and share it with your friends. And don't forget to subscribe to the Spend Smartly channel for more insights on personal finance and smart spending. Thanks for watching.